Welcome to the Emerging Wealth Podcast, a podcast dedicated to tax and financial education for high-income millennials. I'm your host, John Boyd, certified financial planner and founder and lead wealth advisor at Modern Wealth. That's modern spelt with no vowels, wealth. We're a fiduciary fee-only financial planning firm located in Scottsdale, Arizona, but we serve clients all over the country. Welcome to episode 3. All about the power of donor advised funds. So this is one of my go-to favorites on my tool belt when we have someone who is very charitably inclined and also is trying to do everything possible to get a tax deduction, right? This is a really powerful tool. So we're going to talk about why you need to know about it, why it should be on your tool belt, and strategies to maximize it. So let's go ahead and dive in. If you enjoy today's content, go ahead and go to the description of this episode. Click on the link to our learning center. And when you get to our learning center, go ahead and join our mailing list. Our mailing list puts you on our weekly Planning Insights newsletter where we talk about everything from taxes, real estate, investing, early retirement planning, and more. You do not want to miss it. So go ahead and subscribe. So a donor advised fund, or a DAF, DAF, what is it? How does it work? So a little background. So prior to starting my own firm, I used to be an advisor at a very large brokerage firm serving their ultra high net worth clientele. So these were clients minimum $5 million in liquid assets, which would mean that their total net worth, when you factor in real estate, business shares that they owned, all that good stuff, they'd oftentimes be well over $10 million. So very affluent individuals. Another wrinkle to this is that about half of my practice were young tech professionals, oftentimes folks in their 30s, maybe early 40s, in the San Francisco and Seattle area. So these were individuals that were very, very wealthy at a very young age who made a lot generally through equity-based compensation. So they received, shares of their company stock. They just held on to it. Their company stock went to the moon. And on top of that, they had RSU grants that became more valuable. And before you know it, now they have $6-7 million to their name. So the reason why I'm bringing this up is that with these type of individuals, right, they have very high taxable income, really high taxable income. And then on top of that, there's this big elephant in the room with all this capital appreciation of the tech stock or corporate stock that they have in their portfolio. So the $1 million question is, how do we get as much tax deductions as possible to reduce these individuals' taxable income? And at the same time, try to mitigate risk to a degree, all of that concentration that they have in this single company stock that they have. Because sometimes, this is more extreme. I'd work with people who, their total net worth was $8 million and 7.5 of it was just in one company stock. It was crazy. And to find a happy medium behind, all right, let's balance risk and also try to reduce your taxable income, a donor advised fund was a really cool way that we could achieve those objectives. So this is how it works. A donor advised fund is effectively your own charitable fund. It allows you to put money into it. The money that you put into it grows completely tax-free. And then you choose when you want to give that money to charity. So you put money into it, it grows. You don't have to donate right away. You could let the money sit there, let it grow, and then later on, donate it to charity. Keep in mind that the money has to go to a public 501c3 nonprofit organization recognized by the IRS. So if you have someone in dire need who needs your money, right, you can't just put money in a donor advised fund and give it to them, right? It has to play by these rules. Donor advised funds are very low cost and really easy to set up, right? You could quite literally, after you listen to this podcast, Google donor advised fund, bunch of websites will pull up and you could probably have one open up within 5-10 minutes, right? It is that easy. But here's where the tax planning element and why I'm bringing up kind of these folks with all this, highly appreciated stock that I've worked with in the past come into the equation. So with donor advised funds, yes, you can just put cash into it, right? You can link up your checking account to a donor advised fund and make a deposit that way. Or you can move over highly appreciated shares of stock to the donor advised fund. Now, technically, they don't have to be highly appreciated shares. You can move over shares that have a loss, but generally speaking, that doesn't make a whole lot of sense. So cash or appreciated shares of assets. And it could be stock. It could technically be assets like real estate. It could be crypto. Appreciated assets are potentially fantastic items to move into a donor advised fund. So this is how it would work. Let's say you have a stock that you purchased for $10. Okay. Now, 5 years later, that single share is now worth $100. Okay. So it's grown from $10 to $100, which means you have a gain, an unrealized gain of $90. Now, if you were to sell that stock today, you would incur a $90 long-term capital gain, right? So again, in this example, $90, a long-term capital gain of $90, maybe that isn't too bad. Well, let's assume you're in a very, very high tax bracket, right? Maybe the capital gains rate that you are paying is much higher. Factor into the equation net investment income tax as well, right? And now all of a sudden, the taxation on capital gains is much higher. And then add to the equation that maybe you have hundreds or thousands of shares of maybe company stock that is incredibly highly appreciated, and you're sitting on $100,000, $200,000 worth of gains, right? What do? Well, you could sell it. You could incur the capital gain in this example, or you could potentially move those shares to a donor advised fund. When you move the shares to a donor advised fund, you get a tax deduction. That is huge, right? Now, keep in mind that tax deduction is a below the line deduction, meaning that you need to itemize, right? So if you don't itemize on your tax return, then you're not going to be able to get the tax deduction. Okay. So if you want the tax deduction, you have to itemize in order to get the benefit. So keep that in mind. But whether you itemize or you don't itemize, that $90 of gain that we were sitting on, gone, disappeared. You don't have to worry about it. You have moved the shares of that stock to the donor advised fund. Once it's in the donor advised fund, you sell it and no capital gain you have to worry about. Really, really powerful. Again, this is a simple example, but how this would play out in practice is you have folks who were, number one, they had some sort of charitable inclination, right? Maybe they wanted to give to charity, but they just didn't know how to go about it effectively. They were making really good money and they needed tax deductions. They maybe had their SALT, their state and local income tax deduction that they could itemize. They had maybe a mortgage interest they could itemize. And then they had maybe some donor advised fund donations that they made. So when you add all of that, the deductions maybe were really, really big, right? Maybe we're talking $40,000, $50,000, $60,000 worth of deductions when it's all said and done, right? So this was a way to really help reduce overall taxable income and reduce tax liability. And then on top of that, right, maybe they had tons of shares of this company stock. It was maybe a huge risk to them, right? Maybe they're like, well, I don't like the fact that I have 95% of my wealth tied up in a single company stock, but it's also gone to the moon. So I'm scared to sell it. Well, this was a way to, have your cake and eat it to a degree, right? Because we're moving over the highly appreciated shares to the donor advised fund, getting that tax deduction and reducing our overall tax liability while reducing the size of that position in their portfolio. So now that you understand how a donor advised fund operates, how do you optimize it? What are some best practices to know if you set up a donor advised funds? Well, number one, first and foremost, look for highly appreciated assets, right? And again, it doesn't necessarily have to be stock. A good example, we're seeing this a lot, especially from folks who bought crypto maybe 5-6 years ago, is you have folks with crypto that's very, very highly appreciated and they don't know what to do with it, right? It's a tax bomb that they're sitting on, right? Well, maybe that's an opportunity to go ahead and donate it to charity, right? Again, it doesn't necessarily have to be just stock, right? It can be a mutual fund, it can be an ETF, right? It can be tons of different assets. But whatever you do, look for something that's highly appreciated. When you look for those highly appreciated assets, you also need to understand your accounting method. Okay, this is really, really important and super underrated in my opinion. So let me explain what this is. So let's say you have shares of, it doesn't have to be a stock, let's just say it's an ETF. And you've been buying this ETF, dollar cost averaging effectively, for years. And this ETF has highly appreciated in value. So when you log in on your phone and you look at that position in your account online, you see all this green, you see all this appreciation. You're like, wow, I've made a lot of money on this thing. And if I sell it, it's a huge tax bomb, right? And you think, well, I'm going to go ahead and move shares over to my donor advised fund. You need to be aware of the accounting method because the default accounting method at most brokerage firms is first in, first out. So the shares that you bought at the beginning, right, maybe 10 years ago, if you donate or sell them, those are the first shares that are either sold or donated. Now, for a lot of cases, that can work fine, right? Because generally, if you bought something 10 years ago, fast forward 10 years later, it must have a lot of appreciation. But that isn't always the case, especially when we're talking about individual stocks, right? Individual stocks are far less predictable, right? You could have shares of a stock that you bought 3 years ago. Those particular shares are down. And then you have shares that you bought last year and those shares are up. It's tough to say, right? But the reason why this is important is that if you move over the wrong shares, right? Maybe you move over the shares with a loss on them instead of the shares with a gain. Well, then you're screwed, right? You completely missed out on another tax benefit. Yes, you get the itemized tax deduction, but if you thought that you were going to escape taxation on the unrealized gain, well, you missed the ball on that one. Something else to really consider with the donor advised fund is a bunching or front loading strategy. So just to talk about how this works at a high level, let's say that you are, let's just call it 40. So you're 40 and you have highly appreciated shares of some sort of asset in your portfolio. You and your spouse, right, are making really good money together, but ultimately, one of you, or maybe both of you even, is just getting burnt out, right? You've been grinding, you've been working super hard, and you just want to go do something more chill, right? Maybe you want to do part-time consulting work. Maybe you want to start your own business and you don't anticipate having income for a period of time. But what you do know is that you plan on working for the next, call it 3 years, right? You plan on working from 40 to 43. And then at 44, you're going to chill, you're going to coast, you're going to make less money, and you're going to try to transition effectively to retirement. Well, if that's the case, these next 3 years, we're dealing with your income being elevated, right? You're still making good money. You're still going to be in an elevated tax bracket for these next 3 years, right? Well, what if we, during these next 3 years, we really focus on trying to get as much tax deductions as possible while your income is still high? So stay with me here. Let's say that you are charitably inclined and you usually like donating, call it $5,000 a year to charity. You do that every year. You've been doing it forever. You love donating to charity. What if you decided, hey, I'm actually going to do 10 years worth of giving. I'm actually going to give $50,000 worth of giving this year. And I'm going to give another $50,000 next year and maybe 20 the following year, right? You're going to give decades worth of giving, consolidate them, front load them, bunch them up into that 3-year window. And the idea is that you're trying to get as much tax deductions as possible while your income is elevated. While your income is really, really elevated, you need those tax deductions. But then once you retire at, call it 4 years later, well, we don't really need those tax deductions as much because you're going to be in a lower tax bracket. So this is a really, really powerful way to potentially reduce your taxable income pretty significantly, which kind of transitions to the next point, building a charitable legacy, right? So in that example where we front load, call it $50,000 a year, right? That's a lot, but let's just say we did that for a 2-year span to reduce our taxable income, and then we're going to retire or transition to early retirement. You don't have to donate the $50,000 right away, right? You can. You absolutely can. There's nothing wrong with that, donating to charity immediately. But if you're just undecided, right? Maybe you don't know where you want to give. You know you want to give. You know it's important to you. You just don't know where. Or you don't want a single charity getting $50,000 at once. Maybe you want to give them some, but you want to spread the love a little bit. Whatever your philosophy is, the beauty of this approach and donor advised funds is that you can invest the money inside of them, right? So those deductions or those charitable deductions that you just put in that donor advised fund, you can go ahead and reinvest that money, grow it. And then if you want to donate it, call it in 10 years, now you have potentially even more money to donate to charity. Really, really powerful. I know that, again, speaking on the background, working with very affluent families, this was really, really popular, right? Setting up charitable foundations, right? Although a lot of very affluent families set up their own charitable foundations, people setting up charitable foundations has actually slowed down quite a bit. And part of it has to do with the rise of donor advised funds. I mean, they're just so easy to set up, they're low cost. You don't have to worry about all the legal and issues that come with setting up your own foundation. I mean, they're just so easy that this can be an easy way to set up a charitable legacy. So again, it's a way that you can potentially do a lot of good. You can get potential itemized tax deductions. You can offload highly appreciated stock and not worry about all that appreciation coming back and biting you on the behind, since the cap gain has been completely evaded. And on top of that, you can build a charitable legacy that you can be proud of, right? That's a big deal. Well, I hope you enjoyed today's content, guys. Again, donor advised funds, not saying everyone needs to utilize it, but when you look at your tool belt, right? Your tool belt of different tools to combat tax issues and optimize your overall financial plan, that should be on there. Doesn't mean you have to use it, but it should be on there in the back of your mind. And now you know when it's appropriate to potentially deploy it. If you need one-on-one advice, right? Because all of the content in this episode is general education only. It is not intended to be specific advice. If you need specific advice, please contact a financial professional like Modern Wealth. If you need a one-on-one recommendation, feel free to visit us at www.modernwealth.com. That's modern spelled with no vowels, wealth. Again, you can reach out to us, ask a question, schedule some time to chat one-on-one about your situation. We're more than happy to help out. I hope you found this helpful, and I hope you have a great rest of your day.